Ryan is 34 years old. He works in software, and at the start of this year, he made one move with his portfolio. He went all in on AI stocks. By May, he was up 28%. He told his wife they should put even more money in. He felt like a genius. And honestly, looking at his account, you can't blame him. But Ryan has a problem. He just doesn't know it yet. Because by the end of this video, you're going to see something that Ryan hasn't seen. You're going to understand exactly why this AI rally is hiding a dangerous trap. And you're going to walk away with 5 specific stocks that I believe are better buys right now than anything in the AI space. But first, the part most people are completely missing, and it's going to change how you look at your portfolio. Quick note before we go any further, I'm not a financial advisor. Everything I share here is for educational purposes only. For your specific situation, always talk to a qualified professional. So here's what's happening right now in June 2026. The S&P 500 is up almost 10% on the year. Sounds great, right? But let me show you what's really going on underneath. 7 stocks, just 7, the so-called Magnificent 7, they now make up almost 35% of the entire S&P 500. The technology sector alone has driven roughly 75% of this year's gains. That means if you own an S&P 500 index fund, you don't own the market. You own a concentrated AI bet, whether you realize it or not. And the valuations? The S&P 500 trades at a forward price-to-earnings ratio of 21. The 5-year average is 19.9. The 10-year average is 18.9. We're above both. Now here's the kicker. June is historically the worst performing month in a midterm election year. According to the Stock Traders Almanac, the S&P 500 averages a negative 2.1% return in June during midterm years. The Dow and Nasdaq both average nearly negative 2%. So we have a market that's overvalued, concentrated in a handful of names, and heading into its seasonally weakest month. That should make every investor pay attention, and it's exactly why I'm not chasing AI right now. Instead, I found 5 stocks that I believe offer much better value. But before I show them to you, you need to understand why this kind of setup is so dangerous, because we've seen this movie before. This has happened before. Let me take you back to 1999. A guy named Dave, around 40 years old, puts a big chunk of his money into Cisco. At the time, Cisco traded at 70 times earnings. Everyone said it was the future. The internet was going to change everything. And they were right. The internet did change everything. But Cisco's stock fell 80%. It took over 20 years for it to recover. Dave's neighbor, though, she took a different path. She put that same money into boring value stocks, companies nobody was excited about. 5 years later, she had doubled her investment. Now, I'm not saying AI stocks are going to crash 80%. That's not the point. The point is this. When the market gets this concentrated and this narrow, history tells us what usually comes next. Over the past 3 years, cap-weighted funds like SPY have outperformed equal-weight funds by roughly 32%. You know when the last time we saw a gap that wide was? The dot-com bubble. It was 31% back then. And when that gap finally closed, value stocks went on to crush growth stocks for nearly a decade. Here's the myth. If AI stocks are working, just stay in AI. Here's the truth. Narrow rallies don't broaden. They break, and the investors who build real wealth before the break are the ones who build real wealth. Even Goldman Sachs published an outlook saying the equal-weight S&P 500 looks like a better bet than the cap-weighted index for 2026. They're watching the same data. So if the smartest money is looking outside of AI, where should you be looking? I spent weeks digging into the numbers, and I found 5 stocks in 5 completely different sectors that the market is flat out ignoring right now. Together, on a $100,000 investment, these stocks have the potential to return over $47,000 based on analyst price targets. Let me show you each one. The 2 picks nobody expects. My first pick is probably the most controversial stock on this list, and I'm going to tell you right now, some of you are going to push back, but hear me out. Stock number 1 is Alibaba, ticker BABA. Yes, a Chinese tech company, I know, but let me give you the numbers before you make up your mind. Alibaba trades at roughly $124 per share. The forward price-to-earnings ratio is about 10. The PEG ratio sits at 0.44. For context, anything below 1.0 is generally considered undervalued. Alibaba is less than half that threshold. There are 39 analysts covering this stock. The consensus rating is strong buy. The average 12-month price target is about $192 per share. That's roughly 55% upside from current levels. And here's what the market is sleeping on. Alibaba's cloud business is growing revenue between 38 and 40% year over year. They've had 11 straight quarters of triple-digit AI revenue growth inside that cloud division. This is, ironically, an AI play, but one trading at a fraction of what US AI companies cost. They also have about $50 billion in net cash on the balance sheet. That's a massive safety cushion. Now, the risk is real. China and US relations could deteriorate. Chip export controls could tighten. Those are legitimate concerns, and I'm not dismissing them. But at this valuation, I believe the discount already prices in more risk than currently exists. If you invested $20,000 at today's price and it hits the average analyst target, that position alone could return roughly $10,900. Now let me show you a stock that's printing money, literally. Stock number 2 is Newmont, ticker NEM. Newmont is the world's largest gold miner, and while everyone's been watching tech stocks, gold has quietly been on an absolute tear. The price of gold sits near $4,500 an ounce. Wall Street analysts are projecting it could hit $5,500 to $6,000 by year-end. Newmont trades at about $108 per share. The forward PE ratio is around 10.5. Analyst consensus is buy, with an average target near $143. Some targets go as high as $176. But here's the number that made my jaw drop. In their most recent quarter, Newmont reported an all-time record $3.1 billion in quarterly free cash flow. Let that sink in. $3.1 billion in one quarter. They also reported adjusted net income of $3.2 billion, which destroyed Wall Street estimates.
And their board just authorized a brand new $6 billion share buyback program. That tells you exactly how confident management is. On a $20,000 investment, if Newmont hits the average target, you're looking at roughly $6,500 in gains. If gold keeps climbing and it hits the high target of $176, that number jumps much higher. So we have a Chinese internet giant trading at half its fair value, and a gold miner printing record cash flows. Two completely different sectors, two completely different stories, both massively undervalued. But the next two stocks are hiding right here in America, in sectors that most investors have completely written off, and one of them just lost 55% of its value, which is exactly why I want it. The American comeback plays. Stock number 3 is Citigroup, ticker C. While everyone chases tech, big banks are quietly generating record levels of capital, and Citigroup might be the most overlooked name in the entire financial sector. Citigroup trades at about $132 per share. The trailing PE ratio is just 13.6. It trades at roughly 116% of its tangible book value. For a major U.S. bank, that is cheap. Analyst consensus is buy. Targets range from the current price up to $170 to $178 per share. JP Morgan, Morgan Stanley, and KBW have all recently raised their price targets on this stock. The catalyst here is a multi-year restructuring. New management is cutting costs, simplifying the business, and using excess capital for aggressive buybacks. Citigroup stock is already up 15% over the past 3 months, outpacing the Dow, and the restructuring is still early. The risk is straightforward. Return on equity is low compared to peers, around 7%, and banks are sensitive to credit cycles. If we hit a recession, Citigroup gets hit harder than most. But at 13.6 times earnings, a lot of that risk is already in the price. On a $20,000 investment, hitting the average analyst target gives you roughly $2,240 in gains. Now, before I show you this next stock, it's actually my most controversial pick, so I want to hear from you. Drop a comment right now. Are you mostly in AI and tech stocks, or are you already looking for alternatives? I read every single comment. Stock number 4 is Lululemon, ticker LULU. This one is going to turn some heads. Lululemon is down 55% from its highs. The stock trades around $132 per share. Most investors see that 55% drop and run the other way, but that's exactly the kind of move that creates generational buying opportunities. Let me tell you why. Lululemon trades at roughly 10.5 times forward earnings. The PEG ratio is 0.63. This is a premium brand, one of the strongest in consumer retail, and right now it's trading at a discount brand's valuation. Here's what's happening behind the scenes. Elliott Management, one of the most aggressive activist investors on the planet, has taken a stake. A new CEO is coming in. The founder's proxy fight has been settled. The company has no corporate debt and over $1 billion in cash. They're actively buying back shares.
The average analyst target sits between $177 and $185. The high target from one analyst is $303 per share. On a $20,000 investment at today's price, the average target returns roughly $6,800. And if this turnaround works, the upside could be multiples of that. Now, I want to be upfront. The risk here is real. U.S. sales have been soft, tariffs are a concern, and the turnaround isn't proven yet. This is a higher risk pick. But at 10.5 times earnings for a brand this strong, I think the reward more than justifies that risk. So we've got 4 stocks on the board: an international AI play at a discount, a gold miner printing record cash, an American bank turnaround, and a premium brand at bargain prices. But my 5th and final pick might be the most relatable one of all. You've probably used this company this week, and right now it's trading at a multiple that makes absolutely no sense. The stock hiding in your phone. Stock number 5 is PayPal, ticker PYPL. Think about that for a second. PayPal has 439 million active accounts, hundreds of billions of dollars in payment volume. Venmo, the PUSD stablecoin, now live in 70 markets, and this company trades at a trailing PE of roughly 8 times earnings. 8 times earnings. For context, the average payment company trades at about 29 times. PayPal is valued at less than a third of its peers. The stock sits around $44.50. Their most recent quarter beat Wall Street estimates on both the top and bottom line. A new CEO took over in March 2026. Analyst targets range from $53 to $59 on average, with some as high as $100 per share. The risk is that PayPal is losing checkout share to Apple Pay and Shopify. Revenue growth has slowed to about 4.5%. Those are real concerns. But at 8 times earnings for a platform with nearly 500 million users, the market is pricing in permanent decline, and I just don't buy that. On a $20,000 investment, the average target returns roughly $3,600. Now let me bring it all together, because individually these are 5 interesting stocks, but together they tell a much bigger story. If you invest $100,000 equally across all 5, that's $20,000 in each stock. If each one hits its average analyst target price, here's what happens. Alibaba returns $10,900, Newmont returns $6,500, Lululemon returns $6,800, Citigroup returns $2,240, PayPal returns $3,600. Your total portfolio gain is roughly $30,000. Your $100K becomes $130K. Now, that's the base case. If these stocks hit the higher end of analyst targets, which is entirely possible given their catalysts, the total gain clears $47,000. Your $100K becomes over $147,000. And even in a conservative scenario where only 3 of the 5 hit their average targets and the other 2 stay flat, you're still looking at over $24,000 in gains. That still beats the S&P 500's average annual return by a wide margin. 5 stocks, 5 different sectors, 5 different catalysts, all sharing one thing in common. The market is looking the other way. The crowd doesn't build wealth. The crowd chases what already worked. Wealth is built by buying what's ignored today and obvious tomorrow. Remember Ryan from the beginning, up 28% on his AI stocks? He looks like a genius right now, but the data says the market is concentrated, overvalued, and entering its weakest seasonal period. Ryan's gains depend on 7 stocks holding up the entire market. My picks depend on 5 overlooked companies in 5 different sectors, all delivering on their own fundamentals. I know which position I'd rather be in, and now so do you. If someone you know is all in on AI and hasn't thought about diversifying, send them this video right now. Which of these 5 stocks surprised you the most? Drop it in the comments. I want to know which one you're adding to your watch list. And if you want to stay ahead of the market and find opportunities before the crowd does, subscribe to the channel. I break down exactly what I'm buying and why every single week. Next week, I'm going to show you how to build a portfolio around these kinds of undervalued picks that generates passive income while you wait for the upside. You don't want to miss that one. I'll see you in the next video. Take care.